Good afternoon.
This week, all eyes were on Fed Chairman Jay Powell as he announced the 9th interest rate hike over the past year, continuing the bank's fight against persistently high inflation. Why was this decision so closely watched? It's because ever since the collapse of Silicon Valley Bank, the Fed is caught between two competing mandates. One is to lower inflation by raising interest rates, making it harder for consumers and businesses to borrow and therefore spend. The other is to keep banks stable, and many banks are seeing their holdings lose value amid rising interest rates. The Fed hopes to do both, but it won't be easy. What can history tell us about what course the Fed is likely to take, and what will happen to the global economy as a result? My next guest is the economic historian Niall Ferguson, the author of The Ascent of Money, A Financial History of the World, and many, many other great books. Welcome, Niall. Let me first ask you, do you think that the Fed has so far handled this banking crisis appropriately?
Well, one of the things we discover when we go into financial history is that when a situation like this arises, whether you're a dove or a hawk, you have to do something, because if you do nothing and you get a generalized bank run, then you face a very dangerous situation indeed. So I think in the short run, the Fed had to do something. And the thing that it had to do was to reassure uninsured depositors, people with deposits in above the Federal Deposit Insurance Corporation's insurance maximum, that they'd be okay. But if you take a step back, it's a disastrous situation to have got into. The Fed shouldn't have had to do this. The FDIC shouldn't have had to do this. Something went terribly wrong in the oversight of not only that bank, but other banks that got themselves into this situation.
And now, Niall, the Fed faces this dilemma, which is, on the one hand, it's been trying to make it more difficult for people to get loans and things like that. But now, in order to solve this crisis, it has to kind of do the opposite. Tell us a little bit about, historically, how do you resolve these two tensions? To explain to people, in the past, when you've had crises, it's been a little easier because the Fed could always cut interest rates as a way of solving the banking crisis. But now they're in this position where they're fighting inflation at the same time that they have to provide easy money for the banks.
Well, first, don't cause an inflation surge. And one has to look back to the mistakes that were made in 2021 to understand how we got here. There was a big mistake, as Larry Summers pointed out, on the fiscal side, superfluous stimulus by the incoming Biden administration. And the Fed, under Jay Powell, was essentially asleep at the wheel and only woke up much too late to the inflationary pressures that had been unleashed. The idea that the inflation was just transitory did the rounds amongst eminent economists, turned out to be completely wrong. And here we are. The nightmare scenario is that you raise rates, you cause financial pressure, you slow the economy down, there's a recession, but you don't get inflation down. That's what went wrong in the 1970s. Now, I think inflation is going to come down somewhat this year, but I don't believe that it's going to come down anywhere close to the Fed's 2% target. And Fareed, I think it's important to remember that not only is inflation not by any means under control, but this banking crisis isn't over. Notice it's already spread to Europe. Credit Suisse had to be taken over in a hasty shotgun marriage with UBS just last week. Other banks are under significant stress. So this is the central problem of central banking in a situation like this. You've got to try and get inflation down, but you might cause such a financial crisis that you overdo it. Then you end up with a significant recession, but you're forced then into taking measures like expanding your balance sheet and not raising rates any further, which cause the inflation to persist. The market doesn't believe Jay Powell when he and his colleagues say they're going to raise rates some more. That's not what the market thinks is going to happen. The market is expecting rates to be cut by the end of this year. And so there's a big tension between what the Fed is saying and what the market's expecting. And this is a credibility problem, which is very, very fundamental.
Very simply, what should the federal government do broadly?
Well, it doesn't want to have a generalized banking crisis. The problem is that if it wants to reassure all those uninsured depositors with large deposits at medium-sized banks, it needs Congress to give it a green light, because under the new regulatory arrangements post-financial crisis, it is not up to the Fed and the FDIC to make up a new rule that basically covers all bank deposits. So it's not actually easy for the government to fix this problem. The other difficulty I think the Fed has is that it really doesn't know how much more in the way of rate hiking it can risk before this banking crisis intensifies. I think this is not just a job for Jay Powell, it's also a job for Janet Yellen. And last week, Janet Yellen really alarmed investors by seeming to suggest that decisions about uninsured deposits would be made on an ad hoc basis. So we'll kind of decide if your bank is going to be systemically important when there is a run on its deposits. That's just not a consistent and credible position. So I think it's as much the Treasury as the Fed that really needs to get its act together here, communicating clearly what it's going to do to avoid a banking crisis and to avoid, of course, a much more severe recession than most people were expecting just a few weeks ago, when the talk was all of non-landings or soft landings. These sorts of Goldilocks scenarios look less and less plausible because of mistakes that have been made by both the financial, the fiscal, and the monetary authorities.
Niall Ferguson, good to have you on.
Thanks, Fareed.